Shopping for a mortgage can get confusing sometimes. Usually, you're working with multiple lenders and they're sending you stuff through email, talking about numbers, and it's all over the place. Super low rates. Some have high fees. We don't know what you're looking at. So, today we're going to break that down a little bit and try to figure out how to read the loan estimate because that's what you need to see to get an understanding of where the fees really are. So, loan fees, that is very confusing. I see it all the time. People shop online, they see these super low rates, and then they get into the loan, and then they finally get the loan estimate, and they're far into it. They've paid for an appraisal, and they're moving along, and then they see this, and they're not quite sure what they're really looking at, and they don't understand all the fees that they're suddenly having to pay or roll into the mortgage. So it gets really confusing. So let's take a look at a loan estimate and get an idea of what you're really looking at. So this is what a loan estimate looks like. And so a loan estimate breaks down and it's a unified form. It's a form that every lender has to use. So every lender has to use this in the same way. And I'm going to point out to you where the real fees are and where the estimated fees are because some of them are estimated. And so they can actually lowball some of that to try to make it look a little better and not make the other fees not look so bad. So let's take a look at that. So when we break it down, we look at section 1. This is going to break down what you're actually doing. It's a 30-year fixed purchase deal. This is what you're doing. Is the rate locked? It says yes. And it shows its rate is locked in this particular situation until 4/16/2013. So that's as long as that rate is locked. This is an estimate. This is an estimate that the government has put out to kind of give us an example. So this is one I'm using. So section 2, that is your loan amount. That's what you're actually borrowing. That's the loan you're doing. That's your scenario. So you'll see it says loan amount 162. You've got a rate of 3.875, and your principal and interest payment are $761. That's your principal and interest. That is not including your taxes and insurance and possible mortgage insurance. Let's look at that in the next section. Section 3, you will see that included. You'll see the mortgage insurance of $82 and now the estimated escrow of $206. That is estimated in there. And then you see his next section, it's only $206, the mortgage, the total payment going down from $1,050 to $968. That's because the mortgage insurance dropped off because it's figuring out how much you've paid down on the mortgage. So the next section down, you'll see is this escrowed in? Yes, you see it checked there, and it is in escrow. So those are escrowed into your payment. So now you know what your payment looks like. Section 4, that's your closing cost and additional costs. The other costs are setting up your escrows. In essence, they're called prepaids and prepaid interest and all that. That's all figured in there. So you got $5,600 in loan costs, and then you've got $2,300 in other costs. And that breaks down on the next page, and we'll show that. The estimated cash to close is your down payment plus the closing costs. So it breaks it all together. That's your total cash to close. That's your bottom line. So this is what the second page looks like, as you can see how it all breaks down. So we go into it, section 5, this is where the loan fees are. This is the one you want to pay attention to because this is the one they have to disclose properly. This is going to show you what you're actually paying the lender. This is how you shop lender against lender. So when you look at this, and a lender's offering you 3.875 in this situation, and this lender's charging you a quarter point and an application fee and an underwriting fee. Some lenders will charge different fees, and I'll show you that in another example in a second. If you look below that, those are all the appraisal fee, the credit report fee, flood determination, flood monitoring, tax monitoring. These are all different fees that lender has chosen to use from service providers. Now, some lenders don't have all those service providers. They have it included in their up top fees, but the section A, that's the section you're really shopping. Appraisal fees are going to vary depending on the appraisers, but they're usually about the same from lender to lender, maybe difference of about $50. But the origination charges, that's where you want to pay attention to. The origination section, That is how you shop lender to lender. Everything else is pretty much an estimate, and lenders can maneuver that to make it look good or bad. So if you look at section 6, the recording fee there, that's probably pretty low in our area. However, in some areas it may not be. Then you've got the transfer taxes, which would show up there. In our area, we have transfer taxes. Some in this area, it's not showing the full transfer taxes. The next section is showing setting up your escrow accounts and paying your homeowner's premium. Section G, setting up all of the escrow accounts, getting that set up. So these are areas where they can maneuver that, because depending on the time of year you close will depend on how many months are collected on that section. So all that is variable. So those are all estimated areas. So if you really want to get an idea of the lender cost against lender cost, section A is what you got to pay attention to. The other stuff can be manipulated and moved to make themselves look good or bad in your bottom line. We like to get them as close and accurate as possible, and even talk to the title companies and get those numbers really, really tight. But that can be maneuvered. So you want to look at section A. That's the section you want to pay attention to. So for example, here's another one you can look at here. They have a whole bunch of different fees in section A. There's a whole bunch of different fees there. And so you have all these little ancillary fees. And then you can also look at this next section. They have all the different areas of different fees, and you'll see the mortgage insurance premium in there. That's the FHA. So FHA has a mortgage insurance premium that's rolled into the loan that's going to show up there, so it can get confusing. Again, section A, look at that. That's how you're really comparing them. You'll see on the other side, the other costs. Again, those kind of line up close to what the other one was showing, but you did notice the other one in section F was showing 6 months. This one's showing 12. So depending on how these lenders want to throw it out there, they can vary it. They can make that variable. So you really want to focus on section A to compare lender to lender. And then at the bottom of it, you will see where you see title fees, and you'll see how if there's any lender credits, and you see the whole bottom line and your bottom line cash to close. If they're giving you a really good, accurate estimate, then those numbers should be close. Online lenders that we find that compete in our local markets usually are off on these numbers because they don't know the local market. We do, so therefore we know what the reality of your numbers are really going to be. So your local lenders are really the way to go to make sure you're getting accurate numbers and they don't change on you halfway through the deal. So again, section A, pay attention to that. Here is the last page of it as well, of the loan estimate. And if you look a little closer, annual percentage rate, that's the one you want to also pay attention to. So what that is that's a government's way of telling you how much a loan costs, the loan fees. So if there's a lot of loan fees, that will be a lot higher than the rate you're quoted. So for example, if you're quoted 3.875, and your APR is 4.274, that means there's some fees attached to that loan. If your APR is 3.9 or 3.875, then that's a lot less in fees. So the closer the APR is to your actual interest rate, the less the fees are. Now, if you're doing an FHA loan or any loan that has mortgage insurance is calculated as a fee because it technically is. So if you have mortgage insurance, your APR will be a little higher. And so that's something to consider in that. But again, when you look at multiple lenders, look at section A, compare the interest rates, and you'll figure out whether or not you're getting a good deal between the two. So that's how that operates. And it's the bottom of this will also show you a couple of things talking about the appraisal, if your loan is going to possibly be sold, and if it's an assumable loan, those kind of things will be on there as well. So that's how basically the loan estimate works. It's pretty simple. It's pretty straightforward, but it can be manipulated and maneuvered a little bit. And so I wanted to show you that. So you really want to focus on section A to compare your lenders to lenders. And again, I recommend talk to your local lenders, put them against each other, because they're going to give you mostly the most accurate numbers to go side by side on. So anyway, wanted to run out there, let everybody see some numbers. And if you have any questions, be sure to reach out. We're here to help. We'll talk to you soon.